Welcome back to the Deep Dive. It is Monday, February 16th, 2026. And if you've been watching the charts, you definitely saw that massive rally. Gold nearly tapped, what, $5,600?
It was an incredible run.
But now we've seen this pullback. We're sitting in that 5,020, maybe 5,050 range.
Yep.
So we've got the gold market weekly outlook here. And the mission today is pretty simple. Is this a crash or is this just a pause?
Well, the data in the outlook is, pretty firm on this. They're calling it strategic consolidation.
Strategic consolidation.
Yeah, and it's a crucial distinction. This is not panic-driven liquidation. We aren't seeing money just flee the asset.
Okay.
It's more like rotational accumulation. The smart money is shuffling positions, really, just waiting for the next catalyst. They're not cashing out.
And it looks like they're defending that $5,000 level pretty aggressively.
Yeah.
That seems to be the big psychological barrier, doesn't it?
Oh, absolutely. It is the line in the sand. If 5,000 breaks, the next structural support isn't until 4,850.
Wow, that's a steep drop.
It is. But for now, that floor is holding up very, very well.
Well, and the macro data seems to support that floor.
Yeah.
I mean, we just got that soft CPI print. Inflation only rose, 0.2%, which signals things are cooling. That's exactly what the bulls wanted to see.
Right. Because of that data, the market is now basically betting on 75 basis points of rate cuts for 2026.
And just to clarify, that's a 0.75% cut.
Exactly. The thinking is it'll likely start in July and a weaker dollar. That's just rocket fuel for gold.
Right.
But it's not only the rates. You also have this geopolitical premium. The ongoing tensions between the U.S. and Iran are keeping anxiety high.
Sure.
And at the same time, we're seeing a rotation out of those, high-flying AI and tech stocks and back into hard metals. Money is looking for safety.
Speaking of money looking for safety, the whales are making some pretty serious moves here. It's not just private capital.
Yeah, not at all.
China has now reported 15 consecutive months of net gold buying.
15 months. And look, JP Morgan is predicting that central banks globally will buy 800 tons of gold this year.
800 tons.
Yes, this year.
So that creates what the report calls a price-insensitive floor.
It does. It absolutely does. Because these institutions, they aren't day trading. They're strategically diversifying away from paper assets.
Like bonds or currencies?
Exactly. They are moving into hard assets, and they are buying regardless of the day-to-day price swings. That puts a huge safety net under the entire market.
And it seems that buying pressure has forced the big banks to completely rewrite their forecasts. I was looking at the revised targets for year-end 2026.
Yeah, they're eye-popping.
JP Morgan and Wells Fargo are now targeting up to $6,300.
And UBS is right behind them at $6,200.
It's a huge shift.
A fundamental shift. You have to remember, just a little while ago, all the targets were in the $4,500 range.
Right.
To move the goalposts by almost $2,000, it shows they don't see this as a bubble. They see it as a structural repricing of the asset.
So the structural long-term thesis is bullish. But looking at the immediate weekly outlook, it sounds like we shouldn't expect fireworks, right this second.
No, definitely not. This specific week requires a bit of patience. The outlook is predicting range-bound trading, probably between 5,000 and 5,150.
And why is that? Just thin liquidity.
Exactly. You've got the Lunar New Year, so Chinese markets are closed. Plus, we have U.S. holidays this week.
Okay, so low volume.
Low volume, yeah. When volume drops, price action gets choppy.
Yeah.
But the overall sentiment remains. Any dips right now are seen as strategic entry points.
So, to sum it up, gold is kind of resting here at 5,000. It's supported by hopes for rate cuts and just massive central bank buying.
That's a good summary.
And the big banks have hiked their forecast to over $6,000, signaling they think this run is far from over.
Yep. And here's a thought to leave you with. If the world's biggest financial institutions and central banks are aggressively moving away from paper assets and into gold at these record prices, you really have to ask yourself, what do they see coming that the average investor doesn't?
Something to think about. Thanks for listening to The Deep Dive. We'll catch you next time.